All right, hello everyone. We're kind of straddling the morning and afternoon depending on where you are, but thanks for joining. Performance and projections, a comparison of SFR, BFR portfolio investment opportunities. We have a star-studded panel before us today, so very happy to be moderating with this group. I think it's great just to go ahead and give everybody an opportunity to introduce themselves. So Michael, if you'd like to start, and then we'll go around.
Sure. Yeah. Thank you, Dalton, and everybody for joining. Michael Finch here with SVN, SFRhub Advisors, and SFRhub.com. I'm one of the principal founders of our SFRhub companies. We do a lot of things under roof, from brokering single-family and build-for-rent portfolios, as well as providing data evaluation and technology services. We are part of a SVN Capital Investment Group that's a partnership with SVN Corporate, looking to acquire build for rent. And we are also have a good relationship and a strategic partnership with an investment banking firm out of New York to help source equity for developers and builders in the build for rent space. So we're kind of all encompassing everything SFR and BFR. So I'm sure there's a number of ways we can help any of you out there, and look forward to the discussion today and fielding any questions.
Great. We have some really good portfolios to jump into here in a little bit, so looking forward to that. Troy, would you like to give a quick rundown?
Yeah, my name's Troy Evans. I oversee our property management sales, including single family owners with one home through institutions with several thousand maybe. Single family traditional assets and some build for rent communities. We currently manage about 5,000 homes across 39 states. I think we actually started working in one more, so we'll just round it up to 40. We focus on the rehab through leasing and ongoing management of these properties for all sizes of different groups. Very excited to be here talking about how we see the current single family rental and build for rent space from communities and one-off homes.
Great. I'll definitely be picking your brain on one of the portfolio scenarios we have here that ties into the build to rent. Mr. John Watt.
Good afternoon, everybody, and thank you so much for tuning in to hear what we have to say, and thanks so much to all our other panelists for all their contributions. Unitas Financial. We have a program in our real estate investor division. I'm the founder of that division, going all the way back to 1993, ensuring whether it's single family rentals, 1 to 4 family rentals, and build to rents. We've got an innovative program that makes ensuring those portfolios anywhere in the country super easy. Thanks again for including us, and look forward to our discussion.
Absolutely. The insurance side of the business is one that I, in a quirky way, love learning more and more about. So I have some targeted questions for you too. Last but certainly not in the least, my colleague across the aisle, Mr. Nathan Trunfio.
Thank you, Dalton. So yes, excited to represent the lending / money side here at Lima One Capital. Again, my name's Nate Trunfio, Senior Director of Sales and Marketing. What we do is finance all things real estate investment purposes. So any investment strategy that you have, we should have a product that fits you. We specialize in providing solutions as much as a diverse suite of products that extends from single family fix and flip, single family rental loans, single family new construction, large portfolio loans, and last but not least, multifamily. So relevant for this panel discussion, we can help finance the front end repositioning of aged assets. We can finance the building on the build to rent side, as well as the rental takeout of any construction loans. So excited to be a part of this well-established panel here. Thank you, Dalton.
Great. Thanks, Nate. So I mentioned we had some portfolio examples to walk through, and I'm going to go ahead and screen share. And Michael, I would love it if you could kind of walk us through these different scenarios. And first, we're going to start, I believe, with the build to rent set. We're looking at, let me get this sharing. So first one we have is the 84 home BFR portfolio in Oklahoma City. So Michael, walk us through this one.
Yeah, this is a great opportunity. We've recently taken this out to market. We're kind of chatting with a number of groups right now. Longtime builder in the community, great opportunity not only to buy these homes at certificate of occupancy in tranches of about 8 to 10 homes per month. It also gives a buyer the opportunity to scale with this builder post completion of this community, if there was that interest. But for this one in particular, high barriers to entry in the Edmond market here, great school districts. This is going to be, in this particular area, is the last subdivision that's going to be approved for kind of higher density, smaller lots. That also has been tapped into the municipal sewer. So, everything else that's going to be allowed by the city in this part of Edmond is going to be much larger homes and larger lots. So this is ideal for build for rent. Rents here are strong. The going in acquisition cap rate is almost a 6 cap. And I think we'll be performing above a 6 cap at stabilization. This is, we get a lot of people that worry about tornadoes in Oklahoma, but this particular area and the hilly terrain, from our boots on the ground, has not seen a tornado ever, at least in the 30, 40 years that our boots on the ground have lived there. So that doesn't seem to be a concern for the Edmond market. These are quality built homes, quality builder, and just, I think it's an awesome opportunity, hoping to, get this under contract in the next 30 days. And as I said, a lot of the buyers that we're talking to that are interested in Oklahoma City and build for rent, are looking to scale in the market. So we have some other opportunities there with portfolios and builders as well, including this particular builder who's got other subdivisions that he could deliver if a buyer was interested.
Yeah, you mentioned one piece, and John, I'd like to pick your brain on this a little bit. Michael, you mentioned kind of the nuance of tornadoes in the area. So John, a question for you, if you could expand on it, how does, how are different risk exposures depending on location? How do you handle that from an insurance standpoint?
Well, if the subject of Oklahoma comes up, a lot of times the first thing underwriters think of is, tornadoes, This portfolio is quite a bit different because now this is built to the most recent building codes. You can see that all of the roofs don't have any gables in them. They're all hip style roofs and so forth. So I would say that the windstorm footprint of this portfolio would be the best available. So this particular portfolio really stands out as something that would probably rate up, absolutely get best rate for the area.
Got it.
To answer the question, different areas of the country, we've got all different kinds of exposure. East Coast, we've got windstorm. It used to be just Southeast Florida and some of the Carolinas. Now it goes all the way up the coast, Gulf of Mexico, everything else. So, each area has its own sensitivities, particularly when we get construction codes like this that would be the best available, then we'll get best rate.
Great. Good insight. All right, Michael, we good to move on to the next one?
Yeah, absolutely.
Perfect. So this one, a 53 home portfolio in Atlanta, Lima One Capital, where I'm headquartered right here in Greenville, South Carolina, about 2.5 hours outside of Atlanta. So Atlanta has been absolutely booming the last few years. So really interested to hear about this particular portfolio.
Yeah, this is a unique one, and for most of you out there that know the the benefits of Atlanta, I don't need to drill into that, but significant value growth, significant rent growth, one of the top 3, markets in the country for single family rentals. This one in particular is about 50% unoccupied, and it was part of a larger portfolio where the seller has been, putting in about $8,000 to $10,000 capex and selling to the retail market. They've wound it down to about 53, 54 homes now, and their interest is selling in bulk. So, for what everybody here, specifically Lima and Marketplace do, this is an excellent opportunity because we've got half of the homes are occupied, and the other half are ready, for maybe a little turn, a little renovation. So they can all be brought up to market rent, or they could be used to really kind of renovate and sell to the retail market, to the for sale buyer. So it gives a lot of optionality here on this one for a buyer. They can rent them all, long-term holds. They can kind of fix and flip the unoccupied ones. So it's a unique deal. We don't really see a lot of portfolios that are 50% occupied with the ability to turn units overnight and either lease or sell to the retail market. So a lot of optionality here in a significant growth market.
Yeah, I mean, you mentioned significant growth market. That last bullet point, Atlanta home values up 10% in 2020 and a projection of another 10% in 2021. Just absolutely on fire. Nathan, if I could pick on you a little bit, I know really all of these portfolios mesh nicely with one product in particular of Lima One Capital's, the Rental 30 Premier. So could you talk a little bit about that product?
Yeah, absolutely, Dalton. Essentially what Dalton's referencing there, we call it Rental 30 Premier, is our large portfolio product. So essentially, whether you're looking to take some of these portfolios in tranches if available, or in full, this is the product for you. It really can give you best execution in regards to rate. And you're looking at many assets, which a lot of your traditional banks have a troubled time underwriting and placing competitive debt on. But this product really makes that process extremely easy. On the stabilized, it does need to be stabilized. So we do have some bridge options that would allow for the value add play or lease up on this Atlanta specific portfolio. But all of the others, our portfolio loan product on an acquisition allows you to get 75% leverage. We have a myriad of different term options from a 5-year interest only, 10-year interest only. We have 30-year amortized product that's an ARM for 5 years or 10 years or 30 years fixed. A number of different prepay options depending on your investment strategy and hold length. The most aggressive pricing is going to be in something along the lines of a 5-year interest only balloon. Just for perspective, all of these portfolios that you're looking at, you would be, as we call it, somewhere with a 4 handle, meaning rates in the 4%, typically 4.5 to 5, depending on qualifications. I will also add, just in underwriting all these portfolios upon stabilization, they all cash flow well, and they all allow us to go to maximum leverage, again, assuming stabilization. So again, a little different on the Atlanta portfolio. We'd be looking at more value add bridge, which we can absolutely do. Depending on how you want to slice that with financing CapEx or just doing it as just a straight loan without any renovation holdback, be 80% without it and potentially up to 90% leverage if you're including some renovations for value add. So hopefully I cover a number of the bases there. And I mean, look, we love these, the two you've seen and the third one coming up, a number of different debt options that we can place, as I said earlier, financing solutions for you.
Yeah, optionality really is key on the product set. Being able to provide, pretty close to what I would call bespoke financing options, right? You really get to be the master of your destiny with, to some degree, leverage and price and prepayment penalty, and really trying to be a one-stop shop for, as many investment strategies as possible. So there's really good insight there. All right, we will move on to the next one. And Troy, I have a question geared up for you after Michael, but this is a 151 home portfolio in Quad Cities. So Michael.
Yeah, this one's a bit near and dear to my heart. I grew up in the Quad Cities. I was born in Davenport and went to the Moline school systems. So for those of you that are not familiar with the Quad Cities, it's one of the top 100 CMAs, or combined statistical areas in the country. It's a very stable rental market, and it's split by the Mississippi River. So you've got Moline and Rock Island on the Illinois side, and then Davenport and Bettendorf on the Iowa side. All these homes are located in the Moline, Rock Island, and Davenport MSAs. And, you know, I grew up in rental homes. A lot of my friends grew up in rental homes. It's a very rent heavy market with long-term tenants. You know, you've got a good solid employment base with John Deere. You know, Caterpillar is not too far away. Alcoa is up the river. You got Walmart, Hy-Vee, Genesis Health, and then one of the, if not the largest manufacturing arsenal in the country at the Rock Island Arsenal that employs about 6,000 people right in the middle of the river. But this is a great opportunity to buy, hold, you know, move rents up. It's under rented. So, you know, a great opportunity to utilize marketplace homes here and really get this institutionally managed and push the rents and drive the NOI. Good opportunity here for a nice stable portfolio of you know, well taken care of homes in a very you know, what would be considered a tertiary market, but a stable market. I think the Quad Cities was the #7 growth market for areas in the Midwest economically, and I think it's seen about 5.2% economic growth over the last 5 years. So good solid portfolio here with good coverage around the Quad Cities.
Yeah, when I was cruising through this deck of 3 portfolios, this one really resonated with me, and I was thinking of how would I describe it, and just incredible value as is with incredible value or incredible growth proposition.
Yeah, there's good upside here in the rents.
Yeah, absolutely. Troy, you specifically came to mind for this one. So how does managing a portfolio of homes, let's take the Quad Cities one here, 151, how does that differ from managing for someone who's in the maybe 5 to 20 home space?
Yeah, when you're talking 151 homes, and to use this one specifically, with as low of an occupant or as high of an occupancy rate as this has, you have to position yourself to focus on resident success moving forward, especially in a long-term hold market. When you have these 5 to 20 home investors, there's typically a good amount of turnover. When you look at the residence side, they're typically in more of those secondary markets where you tend to see a misalignment of rent to tenant stay as far as owner expectation goes. So when you're looking at something like this, we start focusing on the onboarding side. How do we make sure that these 151 plus residents are going to be extremely happy with who's managing the home? I think that focusing on resident success is a really important part, especially as we focus on these growing private equity firms and other groups who are obtaining a lot more single family. You know, you want to make sure that you're driving that vacancy as low as possible over time. 2 is the size of the portfolio from an operating standpoint, where we come in, really matters. It's too small for somebody to probably want to handle it internally and build out a team. It's too big to have somebody manage it on their own. But they do have very specific expectations with what they're looking for. And that's where we come in. We sit down with these groups or individuals, whoever's acquiring it, figure out what's important to them from a process standpoint. You know, what's important to you when we're finding new residents for these, I believe it's 16 vacant units. You know, what's important to you when we're underwriting these residents? We can customize that on our side. What's important to you from a lease standpoint? We can customize that on our side. Reporting, so on an ongoing basis, you know, from maintenance to evictions, you know, what would you want to see if you were handling it yourself? And then we take that and handle it internally. And again, when you work on a scale this big, it makes it easier for us to handle on the back end, have a dedicated maintenance individual have a dedicated property manager, have a very specific dedicated accountant to be able to handle all of those processes. So the difference between the 5 to 20, which we do a good amount of the same reporting, and this somebody who's going to come and acquire the 151, is the difference of how they'd like to see the process in our back end versus our standard process that we have for our roughly 5,000 homes that we already have on our sheet.
Yeah, you used a couple words that I really like: resident success. I like that concept of, a bunch of having a huge portfolio of homes is spectacular, but you want to make sure, if there aren't quality renters in there who are happy, who, have found the ecosystem that can provide everything that they want and need, then you're just going to have a bunch of structures sitting there, right? So that resident success concept is incredibly important, and something that, I think everybody knows, but something to, always be mindful of, right?
If I could jump in and make a couple points real quick, and sorry to cut you off, Troy, but really two good points. One that Dalton picked up on, but the first here at 89%, occupancy, the seller is also, as tenants move, they're looking to sell, one-off homes here or there. So they're not actively trying to lease these, or else I'm pretty confident this would be full, even more so with a professional management company such as Marketplace. Two, for all you investors out there that, are talking to property management companies and trying to decide who to use, I think it's important to pay attention to how Troy is using the word resident as opposed to tenant. And I think that's a good indicator of the type of PM company that you're working with, because when you look at these renters as residents of homes as opposed to tenants, I think it just adds a little, quality and appreciative nature to the role that the property management is taking in taking care of your assets, because these are people, right? And it's important to recognize that. It's
their home, right? While they may not own it, they treat it like their home. And something where, like you had said at the beginning, in an area where renting is very popular, people rent for a long period of time. My family's from Pittsburgh. A lot of areas around there are the exact same way. You want to make sure that there's as little bit of tension on the takeover process of leases as possible. I can't tell you how many times we have residents who come over to us from another management company with their concerns and their questions, and we really want to make sure that we're getting those taken care of. And they say, wow, it's interesting because my last PM company, they didn't really seem to care, or whether they were listening, it's not like they were hearing them, right? So we really strive to make sure that all facets, whether it's maintenance, whether it's legal, should we have to go that route, and like I keep hitting on, resident success is really focused on, because as these residents stay in, you're having a higher success, higher ROI. At the end of the day, you're not losing your money on a vacancy. We still drive to make sure that rents are staying at or as close to market as possible, vacating when it makes sense. But I think it's about positioning everybody's expectations with the humanity of it all at the end of the day.
Well said.
Yeah. And if I could interject one quick thing, on a portfolio of homes like this that's a little bit older, best practices property management on this is really going to pay a dividend, because especially when we're talking older homes, a little leak in a pipe that gets taken care of right away is a relatively small expense. Something that goes neglected and now you have huge water damage. Then we've got big insurance claims, drives rates higher, gives you a problem with your tenants and everything else. So certainly best practices would want to be examined on the for a portfolio like this, and the profitability on this looks amazing. So, just thought I'd interject that.
Yeah, that's why investors should pay attention to tertiary markets.
Yeah, that's a really good point, John. And I'm gonna have a kind of a follow-up question for you on that. But first, I got a little excited and sprinted onto the portfolios. I'm gonna put up a poll question for everybody who's here with us. It's going to ask, what category best describes you? Are you a developer, investor, broker, property manager? or other. So we'll go ahead and launch that, and we will keep on chatting. So John, following up on what you were just talking about, how do you protect your properties from some of the losses that you mentioned? Fire, windstorm, hail, water. You mentioned kind of leaking or burst pipe. Can you give some insight there?
Well, you know, I think Troy could speak to this as well, but I would say that, you know, regular inspections and then having the sensitivity with the clients that when there's something wrong with your house, you know, I'm not going to come in there and, you know, repaint the place and everything for you every 60 days. But when there is a legitimate problem, I want to hear about it. And then, of course, you need to respond to it quickly. Otherwise, because if the tenant has the attitude that the landlord doesn't really care, then these issues fester, and then we have big fat claims rather than small liability issues. And then just on the overall management, you know, periodic inspections and so forth, where you can see what's going on. Again, so that small issues don't turn into big ones. We can't control things like tornadoes and hurricanes and all that kind of stuff, but so much of the rest of it we really can. And there's a couple things that it affects. Obviously, your insurance rates, but the happiness of your tenants and the profitability of your portfolio. Sorry, that might have been a little long-winded.
No, that's perfect. And Troy, I want to hear your input in a second. We very quickly cruise through the poll. So to give everybody an idea of who's joining, it's about 80% investor or broker, a little over 80%. And then a few developers on the call and just a handful of people who selected others. So very heavy investor, broker, and developer. Troy, you know, what would you add to that?
I think as we talk about, let's to keep a focus on the portfolios, you know, as if somebody's acquiring these, probably 1 out of every 10 residents that we talk to bring up some sort of maintenance item, and it doesn't necessarily mean that it was being ignored, right? Maybe they just didn't think about it. You know, you do have times where somebody decides now is the best time for me to say, you know, my sink drains slow, right? Or things along those lines. What we do is we really make sure that we hear them out on that. We have a very, ourselves, and what I think is important, why I'm mentioning that we do it, is a very quick turnaround on maintenance. In our agreement with our owners, there's a specific timing that they have to get back with us on certain things. We have internally staffed phones 24/7 in case of emergencies, those types of things. And what we've been doing is creating auto triggers and emails and things to keep the resident informed, keep scheduling around their schedule as much as possible, things like that, to make sure that not only the resident is comfortable with everything going on, but that there's a very fast turnaround on it. We're not going to get hung up on, you know, your heat's out and you're up in, like I am in Michigan and it was -14, which my heat did go out and it was -14, personal experience. But we're not going to just say, well, we haven't heard from the homeowner, so we need to wait. You know, there are certain things where we set the expectation moving forward. There are emergencies, we will take care of them. Together, let's set certain benchmarks, if you would like, on that sort of maintenance, as long as we can solve the issue. You know, it's one of those best practices to make sure residents feel like they're being heard. We're really fixing the issue now so it doesn't cause more problems later. Burst pipes, as John had mentioned, or different things that can be a headache. And that's our job, is to field those, figure out what the best practice is, and make sure we have the right expectation with everybody moving forward. I think the biggest thing, at least in my part of the industry, that I see a lot is nobody knows what's going on. So the communication across all those fronts, maintenance specific, is one of the biggest things that we focus on.
Yeah, this may be a little too theoretical, but I often find myself thinking of a home akin to a human body, right? If you let one thing slip and keep slipping, then it's not just going to be that thing that's affected, right? You're going to have issues start branching out. So if it's, you know, a weird finicky toilet, that's going to not just affect that one toilet, it's going to eventually go through the plumbing system, and maybe now you have a kitchen sink issue that pops up because of it. So I think proactivity is is really the name of the game there.
And just a quick word. There's tremendous value for having a firm like Marketplace Homes and this isn't an infomercial for Troy. Some people manage their properties with, realtors in different areas and so forth. That's going to be reactionary at best. The services that Troy and his firm put out, that's really going to make your properties, not only at the end of the day, it's going to make your properties perform so much better.
Appreciate it. Thank you.
Absolutely. And Nathan, I know you talked a little bit about the Rental 30 Premier product, and I know a feature of that, and this is kind of an industry standard piece, would be CapEx, right? Like capital expenditure. Can you talk a little bit about that feature and how it helps plan for and resolve issues throughout the life of a loan?
Sure, and absolutely. And I think, it's important to hit that principle head on first and foremost and something that will parlay into talking about build for rent that is alleviated in that strategy is deferred maintenance and continued needed CapEx investments. It's one of the reasons why, build for rent's gotten so much attention because it's a new product, so things shouldn't be breaking. But an older product, vintage, 2, 3, 4, 5+ decades old, things are going to happen, right? I think that is something that we all in real estate investing come to expect. So what we look to do in most of our portfolio loans is set aside dollars per each unit and door, so that when the unexpected comes about, you have some reserve capital in place to tap upon as you complete some of the updated maintenance, whether it's doing some deferred maintenance or some improvements to the asset on the turns and things of that nature. So big believer in when you're penciling out, looking at acquisitions of portfolios, always penciling out some form of CapEx reserves or reserves for deferred maintenance, because again, we don't know what we don't know, and stuff happens, especially in real estate. So it's always good to have the money there so that exactly that you can handle it quickly. Tying into both John and Troy's commentary, one of the biggest reasons that a lot of smaller landlords have a lot of problems with their properties is that they just don't have the capital allocated properly, and therefore they don't act as quickly, or they try to avoid it and say, hey, Mr. Mrs. Resident, can you just wait a month or two? I'll come back and fix it. And then that leads to 2 months, 3 months, and things build up, as everybody said. So hopefully that helps give some, just high level guidance, as well as on our specific portfolio product. We help you by setting some of that money aside.
Great. I'm gonna put up a poll question, one more, and then Michael, I have a question for you. So poll question that's going up is, which asset class are you most interested in investing this year? Pick as many as you want. A lot of investors in the space crossover, right? We have clients who do rehabs, and then they'll aggregate rental portfolios as well. Results are coming back quick and heavy. So existing single family residential and build for rent, those are the two, with build for rent leading the pack right now. So Michael, the portfolios you showed a good cross section of markets, right? We had primary, secondary, and tertiary markets shown. Can you talk a little bit about what makes up each of those types of markets, and what are some of the nuances, if you're investing in a primary market versus going into a secondary and tertiary market?
Sure. Well, I think kind of the big sticking point, especially for investors that don't consider themselves institutional investors. Those institutional investors almost ubiquitously focus on primary markets. So if you're a high net worth guy or gal that has the capital to play in those markets, you're playing against some big hitters. And they're strong markets because they continue to grow, there's good jobs, but you're also going to have lower yields, and that's just to be expected. You move into the secondary and tertiary markets, you're going to have a little less competition, or no competition from the institutional investors, but you also might have to work a little bit harder, but you're also going to be rewarded for those that work. Now, the secondary market in our example at Oklahoma City is a build for rent deal. So these are going to be brand new homes, should be very easy to manage. The lease up is going to be tremendous in that market because it's got the top rated school system in the state and a very affluent submarket. So the tenants there are going, they could afford to buy, they're choosing to rent. But in general, a secondary market's going to have higher yields than a primary. And, when you're looking at tertiary markets, you definitely want to make sure that there's stability. You don't want to buy into a shrinking market, but there are a lot of good tertiary markets that aren't seeing, off the chart population growth, but they're not shrinking or they're growing minimally, but they have higher yields, long-term tenants, and, in some cases, tenants that will rent for 20 or 30 years. And I still, know people back in the Quad Cities that have been doing that. So it's just, I think there's greater opportunity for smaller and mid-sized investors to focus on the secondary and tertiary markets. I also think there's greater yield potential and revenue generation in those markets.
Yeah, definitely the primary market's crowded whenever you're rubbing elbows with institutional investors who deal in, hundreds of millions and billions of dollars. It's just a different environment.
Yeah, and there also tends to be, when there are market corrections, the primary markets certainly get hit harder than the secondary or tertiary markets, just because they see that great value growth, but that value can drop pretty precipitously in the primary markets, where again, the secondary and tertiary markets just don't, they don't have those huge value upside, but they also don't see the same downside. So it's a little more linear and stable with still good income in place.
Right. Troy, I'm curious to hear your thoughts on the management side of the fence. Any nuances whenever you're looking at something primary versus secondary versus tertiary? Oh, you're on mute, Troy.
Oh, the 2020 mute.
Sorry, I had coughed. I forgot to turn it off. My bad. The thing that comes to mind is days on market is definitely the first thing that gets affected as far as a rental goes. In these primary markets, we have a significant amount of competition from a resident side. There's enough job stability in the area, as Michael said, to give you enough qualified residents, where then your days on market shrinks extremely low, right? You have a lot of competition there. Pretty much within the first few days, you have somebody who's accepted, and you're just waiting for the lease to get signed. The secondary market is one I like to play in a lot. The rental return on that's higher. Like Michael said, you're looking at some cash flow instead of just focusing solely on appreciation, but there is still a vein of qualified residents with good high paying jobs to come through middle of the mark days on market. You don't really see any issues with them. They stay 2, 3, 4 years. They're not going to be the 20, 30 year type residents. They end up moving on to buy and or go to a new city that they end up liking. Maybe they have a cooler coffee shop. I don't know. But they end up switching over after that period of time. When we're looking on the tertiary markets, the resident qualification a lot of times could be lower due to credit, a significant amount of debts, unpaid debt, things along those. Medical collections is something that's high. As we all know, healthcare and things in the United States is higher when you're balancing it out with more of a, let's just say, lower paying job, but still enough cash flow. You may see a higher amount of medical collection on somebody's report, but they do end up staying either much longer or much shorter than those secondary or primary markets due to maybe lack of paying of the rent, having to evict somebody. So those are the things that we see broken down by those. My favorite of them all, I think, to manage is secondary. I think it's a very good, it's called Goldilocks of a market from a property management standpoint. You have the high income earning tenants who stay for a few years. There's very low turnover compared to the overall market. They take care of the property like it's their own. It just happens to be that they stay a little bit less than most of the tertiary market residents do.
I got it. And John, I think I want to hear a little bit about how insurance rates kind of are affected between those three markets. And we could use the examples that we had, Atlanta, Georgia, primary market, Oklahoma City, secondary market, Quad Cities, tertiary market. So can you talk a little bit about how insurance rates are affected by those locations? And, really the key question there on the investor side is what can be done to reduce rates? You're on mute, John.
Not very helpful, is it? Three portfolios that are drastically different in their scope. If we look at the replacement cost value, for example, on Oklahoma City there, since that's a new community and so forth, our replacement costs would be less than what the purchase price is. Atlanta, it's probably just about what the purchase price is. And then we look at the 151 unit Quad Cities. That's, the purchase price is only $59 a square foot. It costs more to build it than that. As far as the cost between the three portfolios, all three of these, it's probably going to range just basically on value, because other than a little bit in Oklahoma City, we don't have the disaster exposure, that we do out on the coast. So rates are going to be fairly similar. When we're talking about a new purchase, generally speaking, we don't have past loss experience. That's what's driving the market right now on price, is what has the client's loss experience been over the last 3 years? Somebody that's got a loss ratio that's 50, 60, 70%, then they're going to pay a higher rate than somebody that has a low loss ratio. As far as controlling insurance rates, number one, keeping your losses low. And number two, when we get into portfolios of these size and larger, is explore some larger deductible options. There's no reason to have $1,000 deductible on a portfolio like this. You're prepaying your losses before you even incur them. And quite honestly, the sweet spot in the marketplace these days is probably somewhere in the $5,000 to $10,000 range, where sure, that's going to be an operational hit. But the fact of the matter is the amount of money that you're going to pay in insurance to get those numbers down lower, you're almost prepaying your losses before you even have them. So, take the savings from insurance, put it into your maintenance policies and so forth. You'll be happier, and so are your tenants.
That's really good, actionable advice right there on the insurance front. I'm going to put out our last poll question. I promise I'll stop beating everybody up with poll questions, but this one gets into kind of reading the tea leaves, kind of a favorite game of mine. So it's sort of finish the sentence. The real estate market this year will be ... Do you think it's going to be better than 2022, the same, worse, or excuse me, better than 2020, the same or worse? So we'll go ahead and put this out. And also to everyone who's listening in, we have some time coming up for Q&A. So absolutely, if you have any questions, we have quite a wide swath of knowledge on the panel. So I'd encourage you to go ahead and chat in any questions. We'll make sure to get those answered for you before we wrap up at 2 p.m. Eastern. Michael and Nathan, kind of a game, if you'll indulge me. So if I gave you each $100 million cash and said, go buy rental properties today, within the next month, where are you focusing geographically?
Nathan, you want to go first?
Sure. Yeah, absolutely. Look, I think a lot of my answer is going to speak to personal preference. I think what we've talked around topic-wise, very relevant from a lending perspective, is risk-adjusted returns. right? So I think, you know, an investor needs to understand what targeted returns they want to hit. If I asked anybody, do you want to, you know, do you want a 5% yield or a 20? Most people are going to say the 20 until I tell them, well, that 20 is a vacant warehouse that was burned down and it has to be rebuilt up and go through zoning and things like that. So there's a lot more risk with that strategy. All that to say, personally, with that amount of money, those couple dollars, I would be investing a smaller portion into primary markets. A big believer that I think as much as they will take the bigger hits, they will consistently outperform others, but will drive lower yield. I would invest probably over 50% into, you know, like B-class markets that are probably more secondary. There's a lot of upside in them, especially in right now, my favorite investing place is the Southeast, just because of migration in the urban flight as well from a lot of northern places on the Eastern coast. And then I would also sprinkle in some heavy value add plays, maybe call it 25% of the investment into tertiary markets where, you know, look to invest in more heavy value add, whether that's just rent increases or combined with CapEx investments as well. So very broad answer there for sure. I would probably put a little bit more thought than an off the cuff answer if I had 100 million in my hand, but that's my answer and I'm sticking to it.
I think that was all well said. Personally, I would focus on primary and secondary markets in the new construction build for rent space. I come from a land and development multifamily background, and you know I love you're playing with that kind of money. I wouldn't personally want to be that hands-on. So having the confidence that you're not going to be dealing with CapEx, you're going to have very sticky long-term tenants, affluent tenants with that pride of ownership because they're moving into a new home, and strong and stable markets that are going to generate good yields. I think Nathan brought up a good point though. You do have to diversify. I would certainly look to buy higher yielding portfolios with a portion of that money in tertiary markets, and make sure that I'm hiring the right property manager like a Marketplace Homes to really drive the drive that NOI value. You always want to have a little mix and match of lower, safe, kind of consistent yielding properties. And then, you move into those tertiary markets like the Quad Cities. Yeah, there's going to be higher repair and maintenance and they're older homes, and you're going to have to be a bit more management intensive, but that is going to yield you more return at the same time. So, your investment's going to be generating more cash flow. So I'm a huge build for rent fan, investing in build for rent around the country. And definitely if I just had my own 100 million, I would be finding some attractive high yielding portfolios in tertiary markets.
Great insight. Unfortunately, I left my $100 million wallet at home. So all fantasy right now. But Nathan, can I pick on you real quick? We have the results in. The real estate market this year will be better than, same as, or worse than. We have a clear winner. What would you guess the audience's number one result was?
I'm hoping, and my firm belief is better. I think for a number of factors, just if you look at the fundamentals of supply and demand right now and the inventory levels out there, number one. And number two, I mean, look, we're still recovering from this pandemic. So I think there's some natural, growth and appreciation to get back closer to where we were. I think the government stimulus is going to continue to prop up the market as well as the low rates. So I'm very confident and bullish in 2021. 2022, a little bit different story.
We'll reconvene in February of 22 to kind of see what's going on there. You're correct, right? So almost 80% of respondents put better than 2022. The same as was next, and then we had a small portion put worse than. So it seems like the resounding majority is better than. I was reading an article on a flight a couple days ago, and they had a bond analyst talking about the recovery, and he said you can sum up definitely boiled down, but if you're summing up the financial impact of COVID you're talking about an event that is effectively a quarter of the financial impact of the financial crash of '08 with 4 times the stimulus, right? So, governments the world over really came out sprinting to make sure that we didn't go over the edge of a recession into a depression, to the point where you have to spend magnitudes greater to pull yourself out of that. So interesting that a quarter of the effect, but 4 times the stimulus there. So we have a couple questions coming in, and we'll kick it over to Q&A for the last 9 or 10 minutes that we have. One question, very valid. What is a tertiary market? So I'll open it up. Who wants to take that question? I think Michael, you want to take it?
Yeah, I'm fine with taking that. A tertiary market is not going to have NFL, NBA, any of the typical professional teams. They're typically going to be markets under 700,000 people, if not smaller. They're typically to Troy's point earlier, that they're probably going to have a greater mix of lower income residents and employment base, but largely it's due to population, and just not seeing the type of 2, 3, 4, 5% net migration growth that the primary markets see.
Got it. Makes sense. Another question here from a gentleman in Houston. He said, we are a developer in Houston, Texas, looking for an investor partner to do a 112 unit build to rent. Where is the best place to go? So
in Houston?
Yep. In Houston.
Oh, I mean, it's working very, very well up in the north and northwest of Houston. But, we like to underwrite and help underwrite, multiple sites. We have a consulting arm that works with developers to help assist them. If they're looking at 1, 2, or 3 sites, we can help them identify why, site A is better than B or C. But we've done a lot of work in Houston, and we've done infill deals. We've looked at deals down in very, very South Houston that worked, well near like Galveston. So it's always very site specific. And it's hard to say, what's going to be better over another without understanding, who the builder is, what type of product are they building, who are they looking to build for. There's a lot that goes into it, but I would love to have that conversation offline and see what we can do to help. Great.
We have about 5 minutes left. And again, if you have any questions, shoot them in. But going to go Troy, John, Nathan, just around. And I have kind of a parting question for each of you all. And then we'll open up the very end just for any parting comments. Build to rent, definitely the hot topic right now. And as by what our conversation has been on this very webinar. So Troy, can you talk a little bit about how Marketplace Homes manages, build to rent communities?
Yeah, with the build for rent communities, what you don't get most of the time that others get while buying their one new construction home that they're moving into is, I guess the biggest one to focus on to make it quick would be the role of an HOA in those communities. So what we've had to do, apart from regular ongoing management of collecting rent, maintenance, and things, is making sure that there are strategic plans in place to handle landscaping, holiday decor, lights, and things like that. Frequent checks on the entire community, making sure common areas are taken care of, making sure in a lot of these leases, there may be some smaller bits of rules and regulations like an HOA would have in place that we make sure are being taken care of. I think that if you manage these communities the way that a homeowners association typically, and while they're still buildings, the builder reps and the builders themselves manage these communities to make sure that they're clean, presentable, ready for the next resident that's going to be coming into the house, whether it's almost completed up the street or on turnover. I think is very important for us to focus on, to make sure that we're filling them quickly, that they're presentable, that they are doing everything that people would want with a new construction home.
Yeah, definitely some nuance there. You and the team at Marketplace are exceptionally equipped to recognize and handle it.
You want to add something to that, Dalton, if you don't mind. You know, depending on the build for rent community and whether it's a standalone subdivision or a subdivision within a master plan, if it's a standalone subdivision, it's good to have the underlying CC&Rs and bylaws for an HOA. But if you're going to, you know, hire a Marketplace Homes to professionally manage it, there isn't a reason to activate the HOA if you're going to manage all 100 homes in a 100 lot community. You know, it's good to have it there if, for, you know, the market goes crazy and 5 years down the road, you want to start selling one-offs, you activate that HOA because you're going to have different smaller owners or investors in that community. But, you know, we very rarely see an HOA adding value when it's going to be professionally managed. In some municipalities, it does help on the taxes. So there could be an opportunity that it's advantageous, but in most cases, we ask the builders to deactivate the HOA at completion of the community.
That is interesting. Did not know. It makes complete sense though. John, staying on the topic of build for rent, is there a difference between insuring, you know, build for rent versus SFR portfolios?
The concept is basically the same. Where we're going to have a difference in the build for rent is we don't have the, you know, the maintenance issues and so forth that we might have happen in you know, in properties that are 20 to 70 years old. So where we may have an increased value on those build for rent properties, it's going to be tempered by a lower rate because we certainly have a, you know, a preferred risk there. New building codes, new construction and so forth. So the underwriting is very similar, but we can certainly give a best rate on the new construction. And then if we can give a commentary on what the property management practices are, then sometimes we can tweak that even a little bit more.
Got it. And Nathan, final question for you. The build to rent product at Lima One Capital, right? And I've been at Lima One for about 6 years. And in terms of product development, the fixed to rent and build to rent product suite, probably the most time and effort intensive product that I've seen, from thinking it up all the way through to creation and launch. So can you talk briefly just about that product?
Sure. Yeah, absolutely. So the naming convention of both products makes it fairly self-explanatory, right? In that specifically build to rent, we can provide the financing for the vertical build from, you know, foundation up, and then look to place permanent financing debt on the back end. Some of the major advantages of utilizing sort of a one-stop shop for that is streamlined underwriting sort of on both sides. It also gives you surety of execution to your business plan because we're underwriting the exit financing, the permanent financing that you're going to hold for a lot longer than the building aspect. And so it just gives you that surety that you know what you're going to get sort of on that back end. Also, we use some unique sort of appraisal processes to essentially confirm the same values that are driven up front, or I should say mitigate against them potentially being deemed to be lower. Very much with the demand in new construction, they will be higher come post construction. At least we would certainly all hope at this point. Not to mention with all of that, there are price savings by doing it sort of in one fell swoop of a product. So you'll get discounted rates, discounted fees on the permanent financing by doing the build and then taking out the rental loan on the back end. So ease of execution, surety of execution, price savings across the board. That's probably the triple whammy that really hits that product out of the park.
Great. I want to thank everybody for joining. This panel chocked full from start to finish. You have the lending side, you have the marketplace side, SVN doing great things, insurance, property management. So this is really a full suite panel. Definitely encourage everyone on to reach out to the panelists. If you're looking to get in touch with one of them, you reach out directly. I have my email here, dalton@lima1.com. So feel free to shoot me a note and I'll get you in contact with Michael, Troy, John, or Nathan. So to you four gentlemen, thank you so much for your time and insight today. Really appreciate it.
Dalton, appreciate you you're running the show here. Thank you, everybody.
Yeah, you're most welcome, Dalton, and great job on moderating our webinar today.
Yeah.
We're going to do these web every day, get a good clap and pep talk, make me feel good. I appreciate it, gentlemen. Thank you all for joining and take care.
Thank you.